Welcome to Cheques and Balances. I'm Michael Vincent, this is James Blair, and this is Matthew Harris. And this week, Housing Policy Update.
So every once in a while, when there's an interesting topic that pops up in the news, the media gets hold of, maybe the government makes an announcement, the Reserve Bank, we thought we'd bring it back and talk about what we're thinking about it, what our customers are thinking about as well. But Michael, we have somebody who is very excited to be back, don't we?
He's very special to us.
Yeah. Since Matt popped up in an early episode, every day, James, Mike, please let me come back.
I'm begging you.
Yeah. So in all seriousness, so this week or a couple of weeks ago, we had the paper come out on the housing policy changes and how new builds will take into consideration there. So we thought it'd be a really good idea to have Matt come on the podcast and have a bit of a chat about what the 143 pages mean, because I know you've probably read it back.
Intimately familiar with the document.
Memorised it.
Yeah.
Helped me get to sleep one night.
And then on the other side, probably every 2 to 3 years, this idea of debt to income ratios pop up. Is it a good idea to implement? So Mike, on the lending side, we thought we'd get you to have a chat about that today as well.
Yeah, no problem.
So I don't have much value to add today, except I might ask a few questions. So what we thought we might start with is, Matt, it was a while ago that back in March when the housing policy changes popped up. Can you just give us maybe a quick 30 seconds? What were those changes? What were the ones that went through, the proposed ones?
Yeah, so it was 23 March when that bombshell was dropped on property investors. And to be honest, since then it's been a bit of a roller coaster. The initial panic's worn off and what was left was more questions than answers. And it's been a kind of tense 3 months whilst we've waited for the consultation paper to arrive. And I'll probably be the first to say I wasn't 100% sure it was actually coming. Nonetheless, it's arrived. 143 pages, a very, very long document, but actually very well thought out. And there's some parts of it that are proposed that are actually pretty concessionary to the taxpayer. So to refresh people's memories, what happened is that the government came out and they immediately lifted the bright line period from 5 years to 10 years on existing dwellings. But they remained at 5 years for new builds. And then what they have done is they've proposed that interest deductibility is removed from in situ properties purchased after 27 March, but proposed that it remains for new builds. Consultation documents come out now. The government has absolutely confirmed that interest will be deductible on new builds, and it says a number of times within the document that this is not what they're consulting on. That is confirmed. What they're consulting on is how it's going to work.
And I guess it's been the thing since March is going, well, we know that any existing property, you're not going to be able to deduct the interest, but the whole idea around, well, the confidence that new builds will be exempt, how long will that all work for? We got some of those answers we don't have, but now investors can go forward with some realm of confidence. But I guess the obvious question, Matt, is what constitutes a new build?
It's a great question. So there's a number of scenarios contemplated in the document. The obvious and the one I get asked about the most is an off-the-plans purchase. Anything with a code compliance certificate issued within 12 months is going to be considered a new build. So that will apply to properties purchased after 27 March. If you have a property that was purchased before 27 March, there is a transitional rule where you might be able to shift it into another entity as long as the total time that it's owned is within 12 months of CCC. So further down the document, they talk about instances where you add dwellings to existing land, convert commercial buildings into residential buildings, that will be deductible. There's even a scenario where you have an existing dwelling and you build a new one on top. So it's actually quite wide. It looks like it's going to apply to a lot of different situations. So what is not clear is how long it's going to last.
Were there any indications of possible timeframes of how long a new build will be a new build?
There appears to be 3 main scenarios in the consultation document. One, and they've used a time period of 10 years and 20 years. 20 years seems to be mentioned quite a bit more than the 10 years, so I'm kind of quietly hopeful that that will happen.
Not biased at all.
No, you know, no property investors in this room. Someone turn the light off.
Zing.
This guy gets it. So one of the first proposals is that it will remain a new build for 20 years, regardless of who owns it. So that means that I can buy it first and I can transfer it to you. It retains its new build status. The other side of the proposal is that it could just be a new build for the time that the first owner owns it. And then there's a mix. It might remain a new build despite how many times it changes, but for 20 years.
Yeah. And going back to, say if I bought a new build 12 months ago,
Yes.
and I go, I want to improve the housing supply. I'm thinking about it before the government's thinking about it.
Yes.
I want to do my part. I don't want to steal any existing housing stock.
Yes.
I've done my part as an investor and new warm home for somebody. Is that going to be, do I get interest deductibility if I bought it 12, 18 months earlier?
No is the short answer.
That's tough, isn't it?
It is tough, but I like the way you use housing supply, because when you read the document, it's very clear that the concessions that are in there are aimed at increasing housing supply. So the converting of a commercial dwelling into apartments, for example, the clear outcome of that is that you have more housing supply. Building a minor dwelling, housing supply. Building a dwelling on top, terrace housing. So it is directed at increasing supply. It's just that 12-month concession, they actually call it a transitional period. If you're outside that, I think you're going to struggle.
Yeah. And I think some of it's quite smart in terms of, like, if you've got a 6-bedroom house and you turned into 2 3-bedroom houses, well, instead of one family, you've now got 2 families with the ability to live in, and that becomes deductible. Are there any other interesting kind of scenarios like that?
Yeah, so there appears to be a few little loopholes, for lack of a better way to describe it.
Loopholes.
Yeah.
We all do, and I think you need them in tax. So when I talk about tax holistically, it's kind of like a game. There's a rule book, the Tax Administration Act or the Income Tax Act. There's a referee, the Inland Revenue, and then there's the players, which is the tax agents, the lawyers, and the taxpayers. So what I've seen so far is that it appears that if you have a home that is your dwelling, but you also rent some rooms out, interest is still going to be deductible. It is proposed that short-term accommodation, so that's hotels, motels, but not commercial ones, Airbnb type operations will still be deductible. And then something that is actually really surprising to see in there, but quite welcome, is they are proposing rollover relief, which means that people can now change entities. So prior to Brightline, if you came into the office and you had a good commercial reason to restructure into a trust or a company, we would just go and effect that restructure. 2-year Brightline came in, we would have to wait 2 years, but all in all, didn't disadvantage too many people. Now with a 5-year or 10-year Brightline, you were previously effectively locked in to holding it in the entity that you started in. So the rollover relief proposes that if you transfer to another entity, has substantially the same economic ownership, then you won't trigger Brightline and you will not lose interest deductibility.
Yeah, I think that's really important for investors and property owners in the space, because we quite often see over maybe over 2 years, not so much, but over 5 years, 10 years, people's circumstances change. People go start businesses, they need to protect their assets, and not being able to put the assets in a trust or a company or something like that is a real hindrance.
Yeah, exactly. Taxpayers should be able to make commercial decisions. And actually, a rule in tax is that tax shouldn't drive decisions. In this case, it's driving. It definitely does. I'm not that jaded by the tax system to think it doesn't, but it definitely, when you've got a situation where you can't make a decision because of the tax rule, that's effectively the same thing.
So, if we're kind of summarising that, we've got confidence that now that new builds will be exempt. There's not just a new build house, but for those that maybe play in the DIY renovation space, there's some opportunities. We think maybe there'll be a 10 or 20-year horizon. Those things that we're not sure about yet, has there been any indication of when we will find out?
Well, the original timeline was 1 October. So based on the fact that we've now seen this discussion document in June, I think probably we're going to find out in 1 October. So it is probably pretty important to note that this is all just proposed. I don't think that all the good stuff will come out, but I think that it's promising to see some things that are actually common sense and that aren't just landlord bashing, which is kind of how it's felt in the past. So all in all, I think a bit of a tick to the government for coming out and actually giving something to discuss, and not only that, but putting forward some options that are kind of common sense.
Yeah.
So if you want to increase housing supply, let these investors who effectively are responsible for housing supply in some way or another play their part.
Yeah.
So I think it's pretty good.
Yeah. And what do you think about like creating almost like a two-tier market,
Yep.
and then how long that new build space is a new build space? Do you have like inflated house prices because of, I mean, people don't make decisions around the tax, but clearly
Yeah.
making decisions around tax.
Yes.
What they'll decide to.
Yeah.
What do you think will happen to the housing prices for those new builds for that period?
I definitely think we've got a two-step
Yeah.
tax system now for investors. If I buy an in situ and you buy a new build, then we're going to get treated differently, even though we're fundamentally the same taxpayer. So I don't think that's a very good thing. I think it's pretty clear that terraced housing supply and demand is going to be out of whack for a while. Developable sections, so anything that can be chopped in half or actually built into terrace housing is going to be quite desirable. And where does that leave in situ dwellings? Well, I think the theory behind this is they'll get snapped up by first home buyers.
Yeah.
I think the reality is that they won't.
Yeah.
And those will not increase in value as quickly, and it may even go backwards a little bit in value depending on how the next 4 years play out.
Yeah.
Yeah. I'll ask you one more question, Matt.
Yep.
Around developers, I've read a little bit around firstly, a lot of developers don't have anything to sell at the moment
Yeah.
because they're trying to find land, so they don't necessarily looking for more customers because they're just trying to keep it pumping.
Yes.
But what are your thoughts around those that say this puts a lot of additional power with the developer and able to fatten their margins up?
I think that definitely if you're a developer at the moment, you'd want to be taking a bigger margin. I actually don't think it's greed. I think that the property market is very volatile at the moment. You've got governments coming in and legislating, you've got the Reserve Bank pulling every lever that they can conceivably think about, which obviously Mike's going to discuss in a minute. And when you're a property developer and you're running a property development business, it's not just buy land, put a house up and sell it. Who says that next time you go to buy some land, that land's even going to be available?
Yeah.
So there's risk out there for these guys, and I think that they are commercial business people. They will be trying to factor that risk in as much as possible.
So building in a bit of a risk
Yep.
margin.
Yep.
And if you think about the attractiveness of those new build properties, that's going to draw more people into that space, which effectively just increases the competition for property developers in that market. So they are going to start to push that risk margin out.
Yeah. So I mean, that's a significant lever that the government has pulled around tax deductibility. Brightline's been a lever that's been pulled as well. LVR's been pulled as well. Mike, I don't think there
What
was
else
many,
do we have to pull?
I don't think there was many levers left.
Yeah.
But Grant Robinson, has found this one called debt to income ratios,
Yeah.
and is kind of thinking maybe I'll pull it, and maybe this will be another thing that will lead to, I guess, more power with the first home buyers.
Yeah.
First question. What does debt to income ratio mean?
Okay, so debt to income ratio is really just the ratio from how much you earn to how much you borrow as a multiple. So if I earn 100,000 and the debt to income ratio limit is 6 times, I can borrow 600,000. So plainly, that's what it means.
Okay. So if I'm in Auckland and I have a reasonable salary of $100,000, maybe a joint income of 150K with my partner, that's still below the average house price, isn't it?
If you have, if you have a joint income, it's going to be a lot easier. So if you're looking at the average debt to income ratio in Auckland, you're probably looking just over 6 for a lot of the markets, so 6.1, 6.2. Christchurch, you're looking at 4 times. So automatically, it's going to be harder in Auckland to buy with these debt to income ratios applied if there's no variance to sort of how they're applied to the whole of the country.
Yeah. So maybe Auckland and Wellington, those debt to income ratios will have a much bigger impact. For those in the regions or those in Christchurch, maybe a little bit better. Is this something that, I mean, it's very early stages, it's more of a discussion at the moment. Is this something that is going to apply to everyone? Will our favourite first home buyers be excluded? What are we thinking?
Well, I guess not so much the request, but the intention from Grant Robinson is actually that the first home buyers will be excluded, but the Reserve Bank has sort of come out and said no. This isn't specifically to control house prices, it's about economic stability. So I don't think they're going to be looking at excluding first home buyers from this. will it impact first home buyers more than the rest of the market? That sort of remains to be seen. Where is that debt to income ratio set? And essentially, what is that going to look like? Because, if you are single and you only have one income, and that debt to income ratio is set at, say, 6 times, you're going to find it very hard to purchase in Auckland, reasonably a property that you want. For a couple that have a joint income, that might be a little bit better. But yeah, it remains to be seen how badly it's going to affect those first home buyers.
And it doesn't make sense for a debt to income ratio to be not applied across the board because it's meant to stop people over leveraging themselves. So if you exclude the people who are most vulnerable to doing that, first home buyers, then you're not really applying the whole purpose of it properly. What I think's interesting actually is that if I'm a first home buyer and I've got access to the bank of mum and dad, then I can effectively manipulate my debt to income ratio because I just put in a higher deposit.
Yeah, and I think that's, it doesn't take a genius to figure out that, a broad stroke approach like this is always going to affect people on a lower income more than it's going to affect people on a higher income who just generally have more options to get around these things.
Yeah, I think there's a few things in there, Mike. One is, all banks are stress testing at a higher interest rate, right?
Yep.
So the banks don't want to lend money to people who can't repay the money. Otherwise, the bank's model doesn't really work. So the idea of providing more stability to the economy when banks are already stress testing at 6-7%. Is it going after investors again and going, this is another lever to pull, or is it actually about stability in your opinion?
In my opinion, it's about going after investors again. The PC answer is different, but actually I think this is about going after investors again. If you think about the way that banks operate at the moment and how they stress test loans, they have LVR restrictions, we have the stress test interest rates, we have all sorts of instruments that they look at or use when they're assessing loans to make sure that the person can afford the loan. They have a little bit of variance in that. So if I take the example of, let's say a young doctor and maybe a young nurse as well, a couple looking to buy a first home, well, actually just a young doctor. At the moment, what I would generally be able to say to the bank if we were getting up to that sort of 6 times, 7 times, income ratio is, hey, this guy here actually has, guy or girl actually has pretty good income potential over the rest of their life. So they're a good bet. And what you're doing when you formalize a debt to income ratio is taking the power away from the bank to sort of make decisions based on the individual customer. Say, actually, sorry guys, we can't go outside this debt to income ratio anymore. And yeah, you are a good bet. And last week I would have given you the loan and you would have been a little bit risky, but you probably would have paid the loan back over time.
Yeah. I see kind of 2 scenarios playing out. One, which has happened a few times in the past, this gets brought up and there's no action off the back of it, only for it to come up in a couple of years' time. The second option, if we're being honest and realistic, there's no way that first home buyers will get included in this. I can't see a way where first home buyers will be excluded for it to get passed. So what are the implications to the market if this gets, does it make an impact, or will that keep going on? What do you think?
It's all going to come down to where that debt to income ratio is set and how it's calculated, because although I've given a really simple way that you calculate this, there are actually a lot of different ways that you can sort of slice this up. So if it's broad stroke and it's just, hey, this is 6 times debt to income rate, gross income versus total debt, then it may have some impact, mainly in Auckland and the larger centres, but through the rest of the country, probably not so much. It just remains to be seen. To be honest, given the tools that the bank have at the moment, it's probably more of an unnecessary burden than anything else. I don't think it'll make a huge impact if it's implemented correctly in the way they're probably going to do it.
Yeah. And if we come back to those levers being pulled, I think about a couple of other things on top of them. One is interest rates being so low at the moment. And interest rates are really, I think we all agree, are the biggest fuel to where housing prices have got to.
Yeah, absolutely.
The second risk in the future is around, as we know, responsible lending has changed, where there's more, it's stricter on what people can do. So what will happen to interest-only periods in the future, who knows, or depending on your age, maybe you have to start to pay a bit of principal. And if some of those things happen, and then you've got 40% deposit for existing properties, debt to income ratios, they all, tax deductibility and the attractiveness. they all kind of all add up. So you're just wanting to, while a lot of these things are still being discussed and the implications haven't been found out, making sure that you've got the financial strength to weather those higher interest rates and those other
Yeah,
factors.
absolutely. I think Mike put it quite good the other day when we were chatting in the office. These things take a really long time to come in, and it might be 4 years from now that the property market looks totally different to how it does now.
Yeah.
And I can actually see a future where property isn't growing at 9% a year. I mean, it's been 21 annualised, but it's 9%. It's been 21 this year, 9% annualised now, up from about 6.8.
Yeah.
I can see a future where actually property just drops down to a normal growth rate, maybe 2% above inflation, and investors deploy capital in other ways.
Yeah. And if I know you hate it when I get wonky about economics and that sort of thing, but a lot of the levers that have been pulled do have a long lag effect on them.
Yeah.
And the way that they've been implemented, it's all shaping up to hit in about 4 or 5 years. And I think that pulling this as well is just going to add fuel to that fire in 4 or 5 years when you think actually interest deductibility is running out on a lot of properties, bright lines run out on a few properties. Investors are going to start looking at restructuring their portfolios, and you may start to see a really sharp sell down.
Hey, am I allowed to put one caveat on this though? Fundamentals of property will not have changed though. We're always going to have finite land. We're always going to need to house people, and there's always going to be more population to a point.
You can tell who paid for the sign behind it. But I think that's a really good point is, while this might have got a little bit doom and gloomy down the end, whenever there is uncertainty in the market, regardless of the asset or the field you're in, it always creates opportunity. And when everybody is, like if we think about the end of the back of last year, when everybody was buying an investment property because Uncle Jim was doing it and Auntie Mary was doing it, that's just kind of fuel to the fire. But when you're in a position where you're thinking long term and going, it actually doesn't really matter if we've got the cash flow, what happens in the short term. So we'll wrap it up there. Matthew, thank you very much for coming on.
So happy to be here.
Did he do a good enough job to get another invite?
Maybe. We'll discuss later.
Okay, all right. We'll discuss off camera. Please make sure to give us a like on this video. Please give us a review, and also tell a friend. If you've got an idea of a great podcast topic for us, we'd love to have you send it through, and we look forward to seeing you next week.
We'll see you next week.
Thank you.